All right. Happy Fed Day, you magnificent melon heads. 50 basis points. Just hit the tape a few minutes ago. The Fed has raised interest rates by 0.5%. A basis point is 1%. And it just hit the tape. That is no big surprise there. The market was largely expecting 50 basis points. There was an outside chance at another 75 basis point rate hike, but to be honest with you, I didn't really think that was in the cards. So there we go. The Fed has raised again. Now, many are out there saying, this is it. This is the pivot. The Fed has finally pivoted. I am not among them. This is a slightly less hawkish. This is a move in a more dovish direction, but it is still a hawkish move. They just raised rates by 50 basis points. And right up until last year, this would have been the biggest rate hike in history, or at least a tie for it. So to see a raise by 50 basis points, this hardly screams dove to me, although it is slightly more dovish than they were a month ago. I hope that makes sense to you guys. So right now you can see in my head, or above my head here, above the big melon, we've got a couple of charts here. As Jerome Powell is speaking, we'll be watching in real time how the market reacts. I've got a couple of charts queued up there. We've got the S&P 500, which is currently down 14.6 points. We've got the U.S. dollar index, or the DXY, which made a nice big green candle up shortly after that hike hit the tape. We've also got the Dow Jones Industrial Average currently down about 94 basis points. We've got the price of gold down 13 bucks. Let's see what else. We got the NASDAQ down 56, or about 0.5%. The U.S. 10-year Treasury yield, which is currently up about 5 basis points. And, of course, my favorite of the shiny metals, silver, currently down 21 cents, or 0.88%. So we're going to leave this on the S&P while we're talking here. We are about 13 minutes out from Powell speaking right now. What you're looking at behind me here, this is the Federal Reserve's web live streaming website. Last time we did this stream during a Powell press conference, we had some tech issues. So I've got to back up just in case that happens again. So if when Jerome Powell comes out and starts talking, if we get a little bit of an audio hiccup or anything seems like it's not right, give me about 10, 15 seconds. I've got another stream ready to rock just in case that happens. I learned my lesson last time. We can't have tech issues during JPOW. No. So, by the way, I have to say thank you very much to Freedom for All, who says you need a hi mom and dad sticker. I do. That's something we do every time we do one of these live streams. I have to say hi mom, hi dad. I love you guys. Mom and dad are at home watching. They always watch all my live streams, even though mom really isn't that into this stuff, but dad is. Dad never stops talking about it, much like me. So thank you, Freedom for All, for the super chat, the support of the channel, and for reminding me to say hi to mom and dad. You guys are awesome. By the way, if you're new to the channel, please don't forget to hit that thumbs up button. And also, don't forget to subscribe to my channel. We do this every time Jerome Powell has a press conference. We also live stream CPI like we did yesterday morning. And look, let's talk about CPI for a minute there, because yesterday we got a lower than expected inflation print, 7.1% year over year. And the market initially reacted very strongly to that. All right, the market rallied. It was up, I think, like 800 points at one point. And over the course of the day, it gave away almost all of those gains. It closed just barely in positive territory yesterday. So that was kind of telling to me, because historically, whenever we got a really high inflation print, the market would sell off on the prospects of a more aggressive Fed. A more aggressive Fed was generally viewed as bad for stocks. Well, yesterday we got a very low inflation print, relatively speaking. These are by 2022 standards here. All right. So when I say a low inflation print, yeah, it's low for this year, but it's all the way back to where we were in December of last year. But the market didn't really embrace that low inflation print yesterday. It's almost like the market doesn't care anymore about a more dovish Fed. So I'm kind of curious to see how the market reacts to Jerome Powell talking today, because if you ask me, that reaction yesterday, the way that stocks gave back all of their gains over the course of yesterday's trading session, tells me we might actually have limited upside to anything dovish Jerome Powell might be saying today. Now, I also want to caution you guys, this is something I say every time. I don't try to trade around these events, because right now algorithms are driving. There's large amounts of money being moved back and forth very rapidly. The same thing happens after the CPI print yesterday. And, we see that, look right above my head. You see this big green candle down? We could very easily see the big red candle down. We could very easily see a big green candle right back up and then another red one down, right? We get a lot of volatility. I don't even try to keep up with markets at this point. I set my trades ahead of time, if any, and then I sit back and I watch and I wait for the dust to settle. For example, yesterday, if you had FOMO'd in off of that low inflation print and saw the 800-point up right at the open and said, whoa, I better follow everybody and buy everything up. Well, you got burned yesterday if you did that, because the market just gave it all up. And hey, here we are down again today. So that's something to keep an eye on. And we are now about 10 minutes away from Powell talking. And I also have to remind you guys that it's not supposed to work this way. All right. We are not supposed to sit here and hang on the every word of a central banker. By the way, shout out to Financial Prepper. My buddy Chris Taylor is in the chat. Hello, Financial Prepper. Thanks for being here, brother. Had a good time talking to you over the weekend, you and Stacy both. Markets aren't supposed to sit here, and they're not supposed to hang on the every word of these unelected bureaucrats who, with the simple change in the inflection of their voice, billions of dollars changes hands. Free markets aren't supposed to work that way. That's not a fair market. All right. And that's why I always include the hashtag and the Fed every time I do one of these streams. It's just not supposed to work this way. And I got to send a shout out and a thank you to my good friend Mike Binder from Robin RC Models. Thank you, Mike, for the support of the channel. He says, I always trade on J. Powell Lotto Day. No risk, no fun. Well, sir, you have a bigger appetite for risk than I do. Let me just put it that way. Good luck with you. I hope your trades work out well. Me, I'm sitting this one out. I'm going to ride the pine for J. Powell. I got a lot of practice riding the pine. JV letter my junior year in varsity basketball. Yeah. So that I'm comfy on the bench. I'm good with that. Whatever. I'm at peace with it. I've had enough time to get ready with that. But thanks again, Mike. Appreciate the super chat, sir. And good luck on your chats. By the way, Mish is on the stream right now. You'll see my moderator, Mish. He's in the chat right there, and he is also lingering in the background. He's on audio. We'll bring him in afterwards. Mish, how we doing tonight?
Man, I'm doing real good. How you doing?
I am doing very good. What are your thoughts? What do you think are we going to see from Mr. Powell today, and what is the market going to do?
I think he's going to do a lot of talking about not being significantly restrictive yet, and I don't know if it's going to be a Jackson Hole, but I think it's going to be Jackson Hole-like in his hawkishness. And I think he's going to talk about, hey, we're not done yet, guys. Everybody calm down. I think I told you right before stream, all but two of the governors think they should go over 5%. So that would be this plus two more 25s.
And what Mish is referring to there,
25.
What Mish is referring to is the dot plot of where all of the Fed governors foresee interest rates finally settling at. And virtually all the Fed governors, only two, say this 50 that we just got, and then I believe it was 3 additional 25s. Is that what they're calling for, Mish?
No, well, right now they're calling for two additional. Okay. But if we go by what has happened in that past, I think it's going to be 3 25s. And then they will, quote unquote, pause.
Then the pause. Now, the pause, I would call that the pivot. The pause would be the pivot, because you have to stop before you can change directions. Right now, they're just slowing. They're still going the way they were going. And also, they're still engaged in quantitative tightening. They're still destroying money to the tune of, I believe, $95 billion a month is what they're targeting right now. So look for Powell to add a little bit of color on what they're going to do about the QT. All the attention is on the rate hikes right now, but don't forget, they're also destroying money. They're also letting those U.S. Treasuries roll off the balance sheet, and they're supposed to be letting the mortgage-backed securities roll off the balance sheet, but that's just not happening fast enough. So that's something to keep an eye on. Also, in the next 6 minutes, when Jerome Powell starts talking, let's take a look right now. This is the Fed's website here. And right now, there's a whole lot of nothing, just elevator music playing there. So we'll go back and check there right closer to 2:30, and then hopefully not have any tech issues again. Tech issues are not so good. Last time we did this during Jerome Powell, I had tech issues for like the first 10 minutes, and I was freaking out sitting here trying to keep my game face on during a live stream. No tech issues during JPOW. We are not allowed to have those.
So I think it's important to note that they're about to add 50 points of inversion to the overnight rate over the 1 month. And so that becomes a big deal. So I think how the bond market settles by a steepening inversion curve over the next couple days will be telling on how December is going to go.
That's right. That's important because when the Fed, when they hike, they're only hiking their target, their overnight Fed funds rate, right? That's the ultra short end of the yield curve. And right now, the yield curve is inverted. The short term duration U.S. Treasuries are yielding a higher interest rate than the long term. Well, when they raise rates, they only raise the short term, and you don't always see the long term do the same thing. Case in point, let me change this chart above my melon here. Let's bring up the U.S. 10-year yield. You can see right here, we just raised by 50 basis points. The 10-year has only gone up by about 3 basis points, right? So the inversion in the yield curve has gotten deeper. It's gotten steeper. And when the yield curve is inverted, that is the market saying, pucker up, everybody. Something wicked this way comes. All right. And right now, the yield curve is more inverted than it has ever been in any point in history, which means the bond market is telling us something really bad is about to happen. And my guess, sometime in the next 6 months is when that actually happens. And we were kind of talking today, one thing I want to mention, we're going into December right now, folks. We're going into the last few weeks of the year. And there is a phrase called tax loss harvesting that you need to be aware of, because right now there's a lot of stocks that are down big time sitting in people's portfolios. And at the end of the year, people who are owning stocks that are down tend to sell them in order to get their taxable income lower for the year. And here we are, we're heading into the last 2 weeks of the year. There's a lot of stocks that are down. A lot of people are going to want to salvage whatever they can from those lousy trades by getting their taxable down. So we could see a lot of selling into the close of the year. A lot of that may be determined by what we hear in the next few minutes, which we are now 3 minutes out from Jay Powell talking. And also keep in mind, those last few weeks of the year, they also tend to be very illiquid trading days. So that is something to keep an eye on. All right. I see Ken B just came through, but it is not yet showing. There he is. Hello, Ken B, and thank you very much. He says, how come we never hear about the reserve requirement? Well, Jerome Powell doesn't bring up the reserve requirement because the press doesn't ask about the reserve requirement, Ken. And my guess is the reason why the press doesn't ask about it is probably because the press doesn't really know what it is or know enough about it. I mean, I'll be honest with you. You'll see when the Q&A starts after Jerome Powell's prepared remarks, most of these press folks, they're kids. I mean, they're a year or two out of college, especially some of these like CNBC. Well, now Steve Leisman from CNBC, they're not bad, but the New York Post folks, they're just not that well versed in this stuff. And that is something to keep an eye on, whether or not they'll lower the reserve requirements or not, and that would free up a lot of cash in the markets. Another thing to keep an eye on is that reverse repo. They did raise the reverse repo rate, and that's about $2.1 trillion of money that's just sitting out there in outer space. Okay, I see. I'm starting to hear a little bit of audio here. It looks like Powell is about to come out. So let me
see if you can sneak in Steve real quick.
Having 1 second. Let me get this going. Okay, we still got the elevator music. All right, let's get Steve Super Chat in here. Hello, Steve. Steve Woitis says, when we see the 10-year lower than the 2-year, is that the bond market betting that interest rates will be lower in the future? That is people running for safety, Steve, in the long duration assets when you see that. That's what that means. Is it a bet on lower rates in the future? It's a bet on risk in the future is what that is. So keep an eye on that one. And still no Powell yet. He should be out here momentarily. It is 2:29. I've still got the elevator music here, so we're going to keep that one in the background. Bear with me. And thank you very much, Steve, by the way, for the super chat and for the support of the channel. I just want to make sure I do not miss Powell coming out. All right, I've still got the elevator music. Still no Powell over at the Fed. Okay, here we go. Again, if we have any tech issues, folks, bear with me. I have a backup ready to rock just in case we need it. Oh, there we go. We're buffering. Is that what we're going to have again? Are we going to be buffering? Is the Fed going to buffer us the whole time? Nope, we're working. So real quick, while we're waiting for J Powell to come out, let's take a look. We've got the Dow is currently down 111 points or 0.33%. The S&P is down 20 points or 0.5%. And the NASDAQ, where are you, NASDAQ? NASDAQ currently down 78 points or 0.7%. So I'll be switching through these charts as we go while Powell is talking. If I see anything reacting, I will let you guys know. And here is the man, Jerome Powell.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal.
Okay, we got a little bit of buffering
Growth
here.
elevated.
There we go.
Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint. But our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves. And many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
So he's saying future rate hikes are required here. That was big.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But I mean, for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and
all right, so while that's buffering, he just said 25 basis points is on the table for February. So that's why you're seeing the stock market is reacting positively right now. It's a well-timed
and then the
buffer.
question will be, how long do we stay there? And they're the
oh, don't do this to me. Gotta love technology. So Powell just basically said probably 150 basis point hike and then on to 25s from there. The market definitely liked that news.
That will be some time.
Okay.
Now, why do I say that? If you look at the really for a year and a half that supply conditions would get better and ultimately supply chains get fixed and demand settles down a little bit and maybe goes back to services a little bit and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up actually as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe, yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what the forecast reflects.
He just said people. What gives him the right? This is what I can't stand about these unelected bureaucrats.
Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace, and that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's SEP?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby?
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then?
While we're buffering, we just had a big drop. Look at that big red candle in the U.S. dollar index. That is the U.S. dollar index telling us they're predicting a more hawkish Fed in the future. So, I'm sorry, a more dovish Fed in the future, to see the Dixie dropping. So, let's see what is going on.
Best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy.
Oh, that's just lovely. Just lovely that we're going to be buffering again.
As I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria?
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SCP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. And China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really, this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael, Kate.
There was a lot to unpack in that statement. A lot of really nasty stuff in that.
Excuse me, Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
Oh my God.
So
Where do they find
I think I got your question. So, one thing is to say is I think our policies are getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficiently restrictive. We laid out today what our best estimates are to get there. It boils down to how long do we think this process is going to take? And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I would say this.
It is definitely not achievable.
To the extent we need to keep rates higher and keep them there for longer, and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not, and if we do, whether it's going to be a deep one or not. It's not knowable, and certainly lower inflation reports, were they to continue for a period of time, would increase the likelihood of a, so I would put it this way, of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
There has never been a soft landing from the Fed tightening cycle. Not ever. All right, so no, there will not be a soft landing, folks. While we're buffering, let me just elaborate on that. There has never, ever been a soft landing from a Fed tightening cycle. It causes high unemployment and a recession every time. Every time. Jerome Powell is drinking his own Kool-Aid here, folks, when he says that. Now, let's stop buffering,
higher than you thought when you first said that. Just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million.
So that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that, and markets are pretty confident, it seems to me, that we will get inflation under control. And I believe we will. We're certainly highly committed to do that.
Grady.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%.
How about if we change it to 0? How about if we set the goal to 0?
Considering that, we're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Nicole.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored, and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these exacerbate or potential exacerbations in the economy? Are you monitoring?
We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Nancy.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but you know, it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. You're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Greg.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that? Talk a little bit more about that. And really, are you talking about getting Congress action on increasing like legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned. If you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually. It's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is. And that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because, they gave us a job and we need to, do that job.
Labor force participation is low because people aren't making enough. The cost of living grows faster than wages.
Chair Powell.
People are giving
Jennifer
up.
Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No, I mean, what we do is we make our forecasts and we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just, upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course, that's something that we know and we'd see. But as I mentioned, we wouldn't, I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that would mechanically happen like that. It'll be a test of, for cutting rates, I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
How about I unmute myself? All right, at the end there, he did.
Thing to do.
Yeah, he didn't mention maybe we might hike rates or we might cut rates next year because we are desperate to stop a market crash. No mention of that one at all. All right, so we are going to react. Give me just a moment here. I am going to make some very minor adjustments to my stream so that we can bring my man Mish right back in here. Let's make me a little bigger there. Let's get rid of Jerome. Let's get rid of backup Jerome. All right, and there's me in the green screen. And let's say hi to Mr. Mish. Mish, how you doing? All right. So a lot going on there, a lot to unpack. Let me address one thing. I believe it was KDM. He made a super chat comment there about what is all this talk about maybe a recession. And then, he went on to say, I thought we were already in 2 consecutive quarters of negative GDP growth. All right. We did have 2 consecutive quarters of negative GDP growth. But that has gone. Our last quarter's GDP was positive. It was like 2 and change % economic growth for the third quarter. So that technical recession would be over. Now, let me throw the asterisk in there. And a lot of that GDP growth was skewed by the strong dollar, which hurts the trade surplus. It masquerades as economic growth. And also the dumping of the SPR. The dumping of the SPR resulted in a lot of oil imports that were not made, and the releasing of oil into the market that looks like economic activity. So it was fake economic growth in the third quarter. And interestingly, nobody asked him about that at all. There was not a single question raised about, hey, what about the dumping of the SPR and how much of this reduction in inflation can we chalk up to what's been going on in the SPR? Nobody's asking him about that. Nobody's holding his feet to the fire like, hey, Fed, you're taking credit for defeating inflation. How about the fact that most of the reduction in headline inflation has come from energy, and that the Biden administration has been dumping millions of barrels of oil every week since May to suppress energy prices? And, oh, by the way, that is ending now. What do you see as the effect on inflation, which you're telling me you're laser focused on moving forward? How come no questions about the end of the dumping of the SPR and what that could mean for the inflation numbers? Well,
I do agree completely with that. That the driving factor there that came down is not because of anything the Fed did, right? That is 100% selling our future off for today. But what really struck me is He started talking about Phillips for a while in there, and I know Jack heard it, and he didn't want to say anything. But when he starts talking about the natural level of unemployment where it's supposed to be, you're looking at right now it should be about 4.1. I think he thinks it should be 4.3 or to 4.5, which is where the curve currently sits, but it's an unmodified curve. So he's saying we're at 3.567. It needs to be at 4.3, right? So that's a 0.6 change. What's that? 1 million people out of work?
Wow. Yeah, and you know, I really focused in on that when he said, like, this doesn't look like an economy where people need to be put out of work. What gives him the right to make a determination like that? I mean, only an academic could use words like that. Oh, people need to be put out of work. Do you have any idea what that means for people, for a family, like, and how that can result in things like divorce or kids losing their homes or the end of friendships and having to move to a different school? And, oh, how about things like deaths of despair? I'm talking about things like suicide, alcohol-related deaths, DUIs. My God, for a guy like that to sit there and say, oh, this doesn't look like an economy where people need to be put out of work. Understand what they're talking about there. I mean, they're just moving people around like pawns on a chessboard. It grinds my gears to no end. And it
Yeah,
really
when he
gets
starts
me fired
talking
up.
about the labor market, he's literally talking about people losing their jobs.
People's lives. Yeah. You shouldn't play games like that with people's lives. Dan Hedin, thank you very much for the super chat. He says the committee I picture is all these jackholes. Hey, I resemble that. Dressed as clowns playing pin the tail on the donkey to pick what data they like. You know, I think South Park did it best when they did the committee, when they cut the chicken's head off and then they start blowing on the kazoo and they just drop him onto the wheel of monetary policy, and wherever the chicken flops, that's what they decide. Bailout or quantitative tightening. I like the chicken mentality, but I also like Dan Hedin's vision of everybody in clown outfits. Thank you, Dan, very much. I appreciate the super chat, sir, and the support of the channel. There was another one that came in while we were talking, and
I think you hit all those.
Did I get them all?
EC has a new one.
Oh, EC, what did I miss? We're all going to be broke, EC. Let me see if I can find you. There he is. Oh, this scroll function is just terrible. There he is, EC660. Thank you very much. He says, okay, what did I miss? All right, let's talk about what EC660 missed. First of all, the market clawed back a lot of its gains. EC, thank you very much for the support of the channel. Looking at a couple of charts here, the S&P 500 took back about half of the territory it's lost. The DXY initially shot up on the 50 basis point hike and then gave back all of its gains and then some, still dropping. All right, so the DXY is telling us that was a dovish Fed, and I am inclined to agree with the dovish interpretation of the data there. I'll get into that in a little bit about why. We had the Dow clawed back about half of its losses. Gold, pretty much flat, unchanged. The NASDAQ is still in negative territory. All right, so I do think this was a slightly dovish Fed. And the reason I want to say it was slightly dovish, I highlighted a couple of things. He mentioned a lot about time, about how the full effects of the rapid tightening was yet to be felt. All right, that means they're saying, okay, we've done all of this tightening, all this hiking. We're worried we might have over-tightened. He's not saying that. He's not saying we're worried we've over-tightened, but that's what he's implying. So they want to wait. They want to let this catch up. I use the analogy of the shower, right, and the hot water. When the water suddenly gets cold, what do? You crank on the hot water, and then you wait for it to get hotter, right? Well, if you crank on the hot water handle and it doesn't get hot right away, maybe you crank on it a little more. The next thing you know, you've accidentally scalded yourself with steaming hot water because you kept turning up the hot even though you hadn't felt it yet. It takes time for that effect to be felt. So that's what Powell is talking about doing. He's worried they may have over-tightened, or at least he's worried about if they go too much further, they could over-tighten. And I can tell you a lot of economists share that worry that they have already over-tightened and we haven't felt it yet. And he mentioned a couple of times that it'll take time for the full effect of this monetary policy to take effect. So that was the really dovish thing. Another thing he mentioned that it wasn't about how fast he tightens from now on. He was asked about the size of future rate hikes. And Powell all but said the next one is going to be 25 basis points. All right. So right now, the starting point for the next in February rate hike is going to be 25 bips. 50
Yeah,
basis
but I
points
think
is
he also
probably all.
said in there he's got another 50 to go. I mean, it's kind of hidden in there because
That was
he said
the
100, then we raised it 50, so he's got 50 to go.
yeah, and that was the second half of that comment that really stood out to me. He said he's not worried about how fast, so 25s, but then he said the more important thing is how far we go, which means how many 25s. So I think we're looking at 25 in February, and we're looking at 25 until proven otherwise, which means we're done with the 75s. We're done probably with the 50s, and now we're going to do 25s for a while, which is historically that's what they've done is 25-point hikes, right? These 50s and 75s, the 75s had never happened before. The 50s was very rare. So we're going back to, your grandma's tighter monetary policy now. That's what this is more like. So they're going to slow things down a little bit there.
Well,
Now,
I think this is important to note that in 1988, I opened up my first savings account. I got paid 8% interest on a passbook in 1988.
8%.
I don't think people understand the stickiness and longevity of high rates.
Yep. We have been spoiled by years and years of low rates. So that's the big thing you missed there, EC660. And thank you very much for the support of the channel. I really appreciate that. And before I get into Jonathan Ventura's super chat, I just want to mention one other thing that he said. They need to see substantially more evidence that says inflation is coming down before they would consider stopping, which means we need several additional months of consistently lower CPIs before the Fed throws in the towel on this tightening cycle. So we're still a long way off.
Well,
keep in mind,
EJD,
I just mentioned.
Yeah, EJD just brought something up. The Powell did say he does not expect to do cuts in 2023.
Yep. But I think they will do cuts in 2023, but not for good reasons. I think because they'll be desperate to stop the bleeding. I think they'll break something and they'll have to cut, just like they had to abruptly cut in 2019. Okay, let me bring in Mr. Jonathan Ventura, whose super chat is slightly covering Mish's chin there. He says, what is a couple tickers that short the 10-year yield, meaning the stock goes up when the interest on the 10-year treasury goes up? Okay, so when the rate, keep in mind, treasury prices and treasury yields are inversely correlated. So if we see yields rising, that is prices dropping. All right, if you see yields dropping, that's prices rising. So I don't trade too much with the Treasury ETFs. The big one that's out there is TLT, which invests in the 20-year Treasury ETF. All right, and then if you wanted to bet long or short one way, you could do calls or puts in that. If you wanted to make a bet on the price going one way or another, just always keep in mind that inverse correlation between bond prices and bond yields. And full disclosure, I have no position in TLT at the moment, nor any plans to initiate one anytime soon. But that one, if we were to see something like a real panic in markets, historically TLT has done well during that initial phase of the panic because you get a flight to safety on the long end of the yield curve as investors pile into long duration treasuries, and it bids down. It bids way up the prices and way down the rates. And in that case, something like a TLT would do very well while everything else was selling off.
Yeah, apparently it's the TNX is the 10-year version.
TNX is the 10-year. Okay, thank you for that one. But again, I don't get involved in those products too much. Honestly, if there's a panic and a flight to safety going on, I like the shiny metals more so than playing in the bonds. It's just one step below on Exter's pyramid, and during a panic, you want to be as low down that pyramid as possible. Again, I have to throw in all the standard disclaimers and CYMIA, not a financial advisor, not financial advice, all that fun stuff. Do your own DD and your own research based on your unique situation. Everybody's situation is different. And thank you, Jonathan Ventura, very much for the super chat, sir. Did I catch up on everybody there? I think I did.
You are.
Looks like I did. All right, a couple other things that jumped out at me here. Let's see. Take time. We got that. How far will they go? He mentioned a couple times we see goods prices coming down. There was only one number that I'm aware of that saw a negative number in the CPI print yesterday, and that was used cars and trucks. Everything else was higher. The index for energy, I'm talking about year over year. The index for energy was higher. The index for freaking everything was higher. So where does he get off saying goods prices coming down? Keep in mind, a lower inflation number doesn't mean prices came down. It means prices went up slower. All right, so what Powell meant to say was we see goods inflation coming down. Again, that doesn't mean prices are coming down. It just means prices going up slower. And while that would be a sign of progress, it doesn't mean prices are coming down. All right, so that was just outright incorrect information. I can give Jerome Powell the benefit of the doubt there that it was just a bad choice of words and he wasn't deliberately lying to us. Now, when we got to the point about the labor market and about how the Fed is just shocked that they don't see labor force participation rate coming up. And he mentioned a couple of reasons why. One reason he mentioned, it could be from people dying from the woohoo bat flu. 100% factually incorrect, a lie. He knows that. Dead people don't count in the labor market anymore. Sorry, they just don't. Jerome Powell knows that. That was just BS. I couldn't believe he said that on the air. It's either a lie or he's so bad at his job that he doesn't realize that. And if one of his dual mandates is to maximize unemployment, you'd think he knows that dead people don't work and that we don't count dead people when counting the number of people working. He mentioned a couple of other things about people retired and they didn't come back. So, okay, what is that your goal, to force people out of retirement and back into the workforce? And who the heck does that? You want to force mom and dad back into the labor force? They worked their whole lives to retire, and now you want to just crank up their cost of living and put everybody out and force them back in? Good God. Good God. I mean, that was the most awful answer. And look, there's no data out there confirming this, but here is my take on that situation. People are giving up. That's what's happening. I think there are a lot of people, especially in the younger generations, the Gen Zers and the millennials, and I'll be honest with you, it's not how I roll, but I can't say I blame them. They're just giving up. They think no matter what they do, no matter how hard they work, it's for somebody else's benefit, or even if they do benefit somebody, either the government or some greedy someone else is just going to come take it from them. And again, it's not how I roll. I don't embrace that. I don't encourage that at all. If you're thinking that way, you need to stop. But I can see how people get there. I can see how people look at Sam Bankman-Fried finally in handcuffs. But Jesus, it was up to a few days ago, it was looking like he was going to get away with it. Or Ken Griffin at Citadel taking away the buy button when he gets caught offsides on a short, and he just calls in a favor with the exchanges and screws millions of retail investors to save his own butt. I can understand why people would say it's all rigged and just quit and give up. When Ralston Bennett from the CFTC comes in and says, the silver squeeze had so much enthusiasm for metal, but we were able to successfully tamp it down. This is a regulator talking like that. So I can see why people are giving up. And honestly, I think that is why so many have dropped out of the labor force. I think they just believe that no matter what they do, it's for someone else's benefit. And Jerome Powell won't say that, but that's what he's done. I mean, he flooded the system with money, causing this inflation. He spent a year telling us it was transitory. Now the cost of living is going up dramatically, and he's doing everything he can to make sure people's wages don't rise to keep pace with that. In other words, his singular focus is to make everybody else poor. And then he's like, I don't know why people aren't coming back to the workforce. Probably because you ruined their lives, Jay Powell, and they gave up. Jack, get off your soapbox. All right, where's Grandpa? Hey, Grumps. How we doing, Grandpa? He says, okay, super dudes, what do you believe will break that will cause the Fed to pivot in February or March? Bond market is predicting a February or March pivot. Okay. Thank you, Grandpa, for the super chat and the support of the channel. I'm leaning towards a little later than February, March, at least when the pivot actually happens. I'm a little out further, like June timeframe. My guess is it will be pensions. It will be something like happened in the UK. If it comes down to the possibility of grandma's pension going to zero, there is not a politician alive who will let that happen. And Jerome Powell is an academic and a politician. So it will be to save the retirements of the baby boomers, will be why they pivot. Or, to put more plainly, I've been saying for a while now, the Fed will pivot and they'll turn the money printers back on because we beg them to. All right. When everybody's house is collapsing, when everybody is losing the jobs, when all their 401ks is going down, everybody who thought they were wealthy, when it's suddenly all going up in smoke and they're left with the stuff they have in their physical possession in their house and they realize how broke they are, that's when they'll turn the money printer back on. Only because we beg them. February, March, I think, is still a little soon, but we'll see. We've got 2 weeks of December ahead of us. It might be a rough 2 weeks. Thank you very much, Grandpa. I appreciate the super chat.
I think on that, I'm looking at June also because of all the other macro data we're seeing is pointing towards first half of the summer run. I think people also need to understand we're talking long-term trends. What the market does today and tomorrow is a lot harder to predict.
Yep. Yeah. And I mean, keep in mind where we were a year and a half ago, right? The middle of 2021, we were still printing money, $30 billion a month. And they were saying, we don't predict any rate hikes until the end of 2023. That's what they told us in the middle of 2021. Now here we are after 425 basis points of rate hikes. Or is it 450? I don't even know. Right? We weren't even supposed to get 25 until the end of next year. And we've already had 450, 425. All right. So their projections are worth so much toilet paper. That's all I can tell you. They spent a year telling us inflation was transitory and that it was going to just, be done very soon and they're going to keep printing money because of it. And then, we won't have to raise rates until 2023. Well, inflation wasn't transitory. They had to raise rates much sooner, much faster. So, when these guys give you their forecasts, you have to go by their history, and their history sucks. I don't know how else to put it. Their history just flat out sucks. So, look, the market's reaction here, it's still been pretty volatile. It's net down, but it's not down that much. The market does not really seem to care what Jerome Powell just said. And this worries me that the market doesn't care what Jerome Powell just said. Because for the last almost 2 years, right, since the initial hysteria of the pandemic wore off, 100% of the dialogue surrounding the direction of asset prices, the stock market, the real estate market, everything, bonds, it has been purely Fed-driven. Oh, bad news is good news because with bad news, the Fed will print. Good news is bad news because with good news, the Fed will tighten. We're not hearing that anymore. Now the Fed is essentially beginning to move towards a pivot or a pivot, depending on your definition of it. And the market is saying, whoop-de-doo, we don't really care. All right, so this is not good, folks. This worries me. And I would also add that the S&P 500 was at a critical technical juncture. Let me bring that one up real quick. I'm going to put this up on Yahoo Finance. And I know we just had two supers come in. I'll get to those, Mish. But check this one out. I was looking at this chart today, and the Fed was supposed to make or break this one. All right? Look at where we're at here. You connect these peaks from all these little bear market rallies that we've had. Let me get rid of that circle here, and look where we were today. We came just above the 200-day moving average and just above this descending level of resistance, and we got the dovish Fed that everybody was hoping for. I just want to mention, the market got what the market wanted today, and it's still down. So what's left on the upside? What is left to bring these markets higher? Now factor in everything that we've got to the downside and what could potentially go wrong from here, there's a lot more room below than there is above. So now that's the S&P 500. The Dow is still technically in a breakout, and the Nasdaq never even got to the resistance level. So I'm going off what I see in the S&P, but this was big here. The Fed gave the market exactly what it wanted today, in my opinion. And the market shrugged it off and doesn't care. That means this is no longer a Fed-driven market. That means the market right now is more focused on, oh crap, what did the Fed already break, and when do we find out? We got 2 weeks left in the year, and look at all this downside in stocks. That is a lot of tax loss harvesting that is going to go on for the next 2 weeks, folks. There's a lot of downside in stocks coming up. Hey, I have to throw in here the full disclosure and disclaimer right here on my sleeve in invisible ink. It says Perma Bear. All right. So I have to throw that rider on everything I say here. I am not known for my optimism, folks. Definitely not. So keep that in mind. But I just don't see the upside here. I want to say thank you very much to Connect Study World for the super sticker. It didn't come across the sticker. I'm sorry.
It was a thoughtful pose.
It was a very thoughtful pose. Thank you very much. I appreciate the super sticker and the support of the channel very much. What was the name again? Connect Study World. Interesting name.
Yep.
Very interesting. And thank you to Mr. Rory Colgan. Thank you very much, sir, for your super chat. Rory says, just remember, these people create money out of nothing and now are going to be charging the banks over 4%, who will then create money out of nothing, who will charge you at least 8%, all out of nothing. End the Fed. Hashtag end the Fed. And I would just add, Rory, that that POS, who is in the Bahamas awaiting extradition right now from FTX, he was trying to buy himself a piece of that money printer when he bought his little shed bank in Washington State, the Farmington State Bank, and then he renamed it Moonstone Bank. All these crooks in the crypto space that they were trying to buy access to the money printer, they were trying to make it so they could print money out of nothing also. They were already doing it with their fake air tokens and then borrowing against them. So, yeah, it must be nice to have your own personal money printer. Playing games with people's lives, man. That's what it comes down to. They just play games with lives, and I agree wholeheartedly with that last little bit of sentiment there. Hashtag end the Fed, and that's why I include that hashtag on every single one of these live streams. I long for the day when I don't need to do these live streams anymore because there's no such thing as a Federal Reserve, because interest rates, i.e. the price of money, are determined by the free market and not by unelected bureaucrats who print money out of thin air, robbing our savings, making our cost of living going up, dropping a couple of pennies on the dollar in our mailbox, calling it stimulus, saying you're welcome. Meanwhile, all the benefits goes to the people who already have everything and control everything. And then when it causes inflation, predictably causes inflation, which they spent a year lying to us about, saying it would be transitory, then they say, oh no, you poors, you guys make too much money. Now we need to slam the brakes on the economy and put you all out of work to make sure the inflation problem doesn't get out of control. And by out of control, meaning you finally see some of the benefits of inflation. Woo, Jack is on his soapbox today.
You got one
last thing.
And getting a bit along.
Yeah, one last thing I'm going to mention. Look, inflation disproportionately hurts the poor, folks. It drives up the cost of energy, food, and housing. And the poor, that is 100% of their income goes to energy, food, and housing. It benefits the rich who own assets, and assets get all of the money. The asset prices, they see the benefits of the inflation first. So how does the Fed fight inflation? They try to reduce tightness in the labor market, which means they raise interest rates and they put people out of work, which also disproportionately affects the poor. Their inflation hurts the poor, and their solution to inflation hurts the poor. And their 2% inflation target hurts the poor because wage increases are always lower than the 2% inflation target. And inflation is always higher than what the government admits it is with their BS artificial statistic known as CPI. So when they say, are you going to change your inflation target? And he says, oh, no, we're not going to change the target. How about zero? How about no inflation is our goal? people actually get rewarded for responsible borrowing and saving money for the future instead of penalized by the interest rate they earn on their savings being less than the rate of inflation. Good God, these guys grind my gears up. I'm getting red in the face again. All right, guys. Mish, you said I had one I didn't get to. I'm pretty sure I got to all of them here.
Connect actually had 2 stickers.
Oh, another sticker from Connect and another one that just says super sticker. I'm sorry, Connect. The sticker interface.
It was another
for
thoughtful
StreamYard.
one.
Ah, my guy's going like this. Yes, that is a chin rubbing circumstance, isn't it? All right, look, guys. Long story short here. How do I summarize this meeting? And thank you very much, Connect Study World, again for the support of the channel. This was the dovish Fed that the market wanted, and the market didn't care. To me, that tells me limited upside, especially sitting here at this vital technical level in the S&P 500. I think we're looking at markets sharply lower for the remainder of the year. I've been wrong before, so nobody go trade off of what you hear Jack saying. All right, I have no position in any of the stocks that were discussed today. And I have to double down on that because I just read, some social media influencers, 8 of them are being tried for securities fraud right now for pumping up schemes on Twitter and on Discord. Mind who you get your trading advice from, folks. That's all I'm going to tell you. I'm just one voice in the ether here. I'm just a source of information. Don't ever trade off of anything you hear me say. I encourage you to challenge my thought process and my decisions. I welcome the discussion. This is not an echo chamber. This is a two-way thing. And by the way, thank you very much to all of my Patreon supporters. Thank you guys for everything you do to support the channel. I will be meeting with my Patreon supporters over Zoom at 7 o'clock tonight. That is Eastern time to do our weekly Zoom call that we do once a week. And I'm sure we'll be talking all about JPOW and the remaining weeks of the year on that one. And Mish, you got anything you want to throw in at the end here?
Yeah, I think we're going to, you mentioned a little early on the stream about tax loss harvesting, and we are going to talk about Patreon about that tonight. But watch out for it. Be ready with a little bit of cash, and if it happens, you will know.
Yeah. And keep in mind, for the last 10 years, there have been no tax losses to harvest because stocks have done nothing but go up. Since 2011 was the last time we had any meaningful correction. A little bit in 2018.
Well, we had December 23rd of 2018.
Yep. Interesting. Put a pin in that date, December 23rd. Yep. We'll talk about that one tonight on the Zoom call. All right, guys. Thanks, Mom and Dad. Thanks, Patreon supporters. Thank you, everybody, for your super chats and for your time for watching. Please remember to like this before you check off and subscribe to my channel so we can do this every week. And until next time, live small and dream big.